Hello, I am Arlyn Stokes, and this is my current event project for Management 6607. It's called Tide Reverses in Latin America, and I found the article in the Wall Street Journal. The article discusses the overview of Latin America's two largest economies, Mexico and Brazil, and how we're starting to see this huge shift from the traditional BRICS economies like Brazil to a new non-BRICS, new emerging markets like Mexico. It's a perfect example of the turtle versus the rabbit, and how in the last 10 years, Brazil and the BRICS economies were really the turtle, or excuse me, were really the rabbit in this case. And they really came out of the gate really strong. Yet at the end of the day, they might not have set themselves up for the best level of success. We're seeing how maybe they were very not focused on the right areas. They didn't invest heavily in infrastructure. They were too heavily dependent upon China. They were very high debt ridden, and they really caused themselves to have a really high trade gap. And the BRICS, Brazil in this instance, really didn't utilize their last 10 years of prosperity in the right way. Compared to Mexico, who's going to be the turtle in this case, you'll see that Brazil had a booming economy. They were selling raw materials to China. The banks released a lot of cheap credit to the middle class, which helped them grow and get strong. They saw about 3.6 average growth rates, yet their currency started surging in value compared to Mexico, who saw lackluster growth. They had a lot of laws that were banning foreign investment, especially in their oil industry. They had a surge in drug violence. They had about a 2.6% average growth rate, and overall their currency really slipped in value. But now we're starting to see that the tide is turning, and we're starting to see that the BRICS economies are really not the areas that international businesses are going to be focusing on in the next few years. And it's going to be some of the non-BRICS economies, like Mexico. Today, what we're seeing in Brazil, very little investment was done in infrastructure and development and technology over the last 10 years. They really were not very strategic in where they allocated all of those resources. China's need for raw materials is declining. They're looking less competitive in the international frame. Their currency is declining. Their stocks sunk by 10% just in 2013. They're loaded with debt. They have a very high trade deficit. They're not able to pay their obligations off. They're really on the verge of a potential financial crisis. And their real currency is weakening, which means that their imports are becoming very costly. Mexico, on the other hand, they really invested in these lean years. They invested in the right areas. They worked on their labor laws, education, telecommunication. They really are opening up their oil reserves and starting to really bring in some more foreign investment possibilities. They have a really small trade deficit. They're increasing these new places, and areas like manufacturing are really starting to boom in Mexico. And their peso is really holding value. Their inflation rate's falling, and their growth rate is increasing. And they've really set themselves up for success on the international stage. Other international business implications, we're starting to really see that shift from the BRICS to the non-BRICS, like the Mexico. And it's because they were truly strategically focused on those areas that really helped them set themselves up for growth. And not being dependent upon China, that really helped them. And this is very important to people like you and me. It means these new markets are offering an enormous potential for international business. It means that if you're a business that wants to do business in Mexico and you're prepared to make this commitment, you might have to deal with a few short-term risks and volatility, but in the end of the day, it's a great new emerging area for you to focus your money and your effort and your potential manufacturing business. Mexico was very, very smart by thinking strategically and knowing where to invest their money in the last 10 years, infrastructure, and really focusing on their commodities. The United States is particularly interested in what Mexico is doing lately. The U.S. is the largest trading partner with Mexico, and the fact that we're really going to look to them in the years to come for some of their oil and natural gas and not have to be so focused on the Middle East is really going to help the United States. It means that gas prices are going to go significantly lower and will really help the United States in the next couple of years not be so tied to that Middle East market. So at the end of the day, these non-BRICS countries like Mexico really separated themselves from the people like Brazil because they focused and thought strategically. And slow and steady in this case really won the race. They knew that they needed to make sure they had low debt. They were not very heavily dependent upon China. And Mexico really allocated their resources appropriately with the infrastructure and the education and the technology and the labor laws. And at the end of the day, Mexico is truly going to be a big bet for future growth and has really set themselves up in the international business stage for success. So my sources for this article can be found in the appendix. Again, it was in the Wall Street Journal, Tide Reverses in Latin America, and some other additional resources are also found in the appendix. Thank you very much for listening and have a great day.